Good afternoon. Welcome to another webinar from Absolute Wealth Advisors. Today we're talking about asset ownership. Today I'm joined by Quang Tat from SW Accountants and Advisors. G'day Quang, good to see you. Thank you for making some time and joining us today. Quang and I have been working together for about 10 years. He's a supporter of Absolute Wealth Advisors in terms of clients and accounting. And we've got a even longer 18-year relationship back with Michael Goodrick, one of the partners of the firm as well. So it's great that you're able to make the time. Today will be a general discussion, as the disclaimer says up on the screen, in terms of that we haven't taken into account personal situation when any of the discussions are happening today. So if you do need personal financial advice, please speak to your advisor. Alternatively, Quang is available to talk to when we get into the accounting side of the discussion as well. Today is a bit of a discussion in relation to asset ownership. First and foremost, just to get us warmed up, what's one of the big mistakes or lessons that sort of high net wealth clients run into when we think about asset ownership?
From my view, from my experience over the years, Dean, it's usually the actual understanding of who should own the asset and whether they actually themselves know who actually owns the asset. Because often when I inherit a job or take on a new client, I go, so do you know who owned this asset? And they're like, I really don't know. So it's important to, as a client, they need to appreciate and understand who truly is legally the owner of an asset. And what does that mean from a legal perspective and from the accounting and from a tax perspective?
Excellent. And I imagine that some clients buy the asset before talking to you and then just put a name on the contract or something like that and completely forget the fact that they should have got advice before putting a name on the contract.
Absolutely. And often when they do that, it can be too late, because once you put a name, you could also trigger double stamp duty issues, you know what I mean? So therefore, it's always important to ask the question.
Yep, absolutely. So today we're going to go through a couple of different investment structures to talk to you about around owning assets, and just try to highlight some of the issues, advantages and disadvantages of those, just to get a bit of an idea about some of the considerations, Quang, that you would go through if a client were to bring this particular opportunity to you before obviously making the decision to buy. So when does individual names and joint names make sense? Why would you talk people in or out of just keeping it simple and owning an asset in their joint names or the husband or wife's name?
Yeah. I usually have a checklist I go through all my clients when these questions come up. And generally, the key thing is with individual and ownership is about timing. It's about how long they want the asset to be held. Is it a short-term hold, a long-term hold? And do they want to keep things simple? And the other thing is tax considerations like land tax, because if you hold individual name, you get land tax concession. Depends how much property or assets you have, right? But if you don't have that consideration, then if you put another structure, you end up paying a bit more down the track, and you can't just once you acquire the asset.
Absolutely. And so coming down that list, you indicated the alternative of a trust. Explain to us as simply as possible what the trust is and maybe some of the dynamics of how it works and why it works for some clients.
Yeah. Trust is really, it's an entity that holds an asset on your behalf. And usually the way I define it, or I'd see as a usage or benefit of using it, is for asset protection. That's the main prime reason I speak to my client about. And the second is distribution of income and capital. That's the flexibility ultimately the trust provide. And also the third main reason is to provide for succession planning and to pass asset down to generations. Because if you have asset owned by you jointly or individually or through another entity, sometimes it's hard to remove those trusts or let those assets to live longer than you, because once you're not around, the asset needs to be liquidated from you, essentially, or pass out.
Excellent. Understood. And so coming back to that first one of the brick walls in relation to asset protection, how does it work in practicality with having assets within a trust?
Basically, it means that you no longer legally owns the asset. If you have the asset in a trust, then for anyone to try to, if you were personally held liable or you have a creditor attacking you personally, then that asset is generally not counted as your asset for the purpose of liquidation or creditors issues. Then you're basically saying separately entity doesn't involve me, it's not my assets, therefore you can't attack that asset, and that's how you protect yourself.
Yep.
And trust is the most common vehicle for that purpose.
For that. Understood. And it probably goes without saying, but you have to have considered these things before you find yourself in any financial difficulty. Quang, you can't move assets in the night before you get into trouble.
That's right. There's usually a couple of years runway that you have to look at for creditors. Particularly, there's a thing called 4-year rule, so you can't just do it overnight. You have to really plan ahead and think it through. So
Yep.
generally, the conversation about asset ownership is about what is the key priority? Is it asset protection? What is it? Is legal tax minimization, or is it legal structure restriction or limitation? So that's usually a topic of discussion with clients.
Cool. Understood. And so moving down that list, you mentioned the income flexibility side. And I think some people have found a misunderstanding with the structure in terms of how the income and expenses flow within a trust, because it's not exactly the same as owning that negatively geared property in your own name.
No, it's not. And look, generally, it's having a trust is more complicated. It's not as simple as having just a property in a joint name or personal name. Obviously, it's treated as a separate legal entity. So when a income is flow in, you got to look at whether there's any expense that need to be offset against that the asset or the income that's generated by the trust. And after that, you got to go through a lot of administration process of distributing the income out of the trust. So then the question is that UN is who do you flow that to? And that's what the flexibility of distribution piece comes in.
Yep, absolutely. And I suppose the key is that you need to make a surplus in order to have something to distribute. And so I think the negative gearing or tax refund off your personal tax return, you don't necessarily get that same direct benefit when it's in the trust. And I know people have got caught up in that in the past in terms of it's not as good. It may not be as good negative gearing, but obviously there's some other benefits that are coming with it as well. So what are you spoke about the land tax complications. So talk to us about that a little bit more, and then the losses getting trapped in the trust as a concept.
Yeah, so obviously with land tax, trusts don't get land tax threshold because it's not considered to be a vehicle eligible for it. So therefore, if you're going to go and acquire a property in a trust, you've got to factor in additional costs because normally an individual get their land tax free threshold. So factor that in as part of additional costs if you'd be better to use a trust structure, there's just more extra layer of costs. And then you can look at where there's enough income being generated to cover that extra cost. And like you mentioned earlier with trust, some clients have the mistake they think they're going to put the trust, their property or assets in the trust, and the trust then effectively end up being negative gear or making a loss. And when a trust makes a loss, it basically gets trapped. The loss can't actually flow out, distribute out. A lot of clients tend to think, oh, I can get the loss out to myself and reduce my personal salary income or other income I have. It doesn't work that way. The trust, usually, my analogy for clients is like a funnel. You can hold an asset, but the income generated must be flow out, less expense, less outgoing. If you don't make any a positive income or profit, then it gets trapped in a trust, and therefore the notion of negative gearing a trust only work if you can able to push or distribute more or bring in more income into the trust, apart from that particular income generated by that particular asset that are losing money.
Yep, absolutely. And so this is the consideration of the trade-off is that you may get the asset protection, but the tax effectiveness may be different as a result. And so working with you just to contrast all of these advantages and disadvantages, I think, is definitely key. The next part of a common structure for high net wealth clients also adds this concept of a corporate beneficiary or a bucket company as a concept. How does that work, and what would be the advantages in terms of wealth accumulation to a family?
Yeah, so bucket companies are quite a classic example commonly used over the years. And the way it works is let's have a very simple scenario. You got a family trust runs a business. That family trust is run by mum and dad, and there's only one adult child in this scenario. And you basically have the business being the trust makes $500,000 a year, and basically mum and dads get $200,000 income each. What's left is $100,000 from that profit from that trust making the income. And it needs to go somewhere. And obviously, let's use the example of the adult child's already got a salary, already on a good income, on a highest tax rate of 47. It doesn't want to distribute any income or receive income. Therefore, the 100,000 has to go somewhere. It's often commonly used by families to add a structure called bucket company. The bucket company then effectively receive that $100,000 instead of the adult children, and therefore it effectively can reduce its tax rate. And the tax rate can be reduced. I wouldn't call it reduced, it's more the tax deferral. We'll explain that in a sec. But it effectively means that on any given year, the trust is basically pushing $100,000 income to the bucket company and paying tax at 25 or 30% versus paying at the mum and dad rate, which is on a highs of 47%. So essentially using a bucket company to minimize the tax each year and defer it, and then later on and use that company and loan it out and use the asset to invest. And that's how, and essentially is to defer and minimize the tax along the way as you use the vehicle, essentially.
Yep, understood. And what mistakes get made in and around using these bucket companies? What are a few things we need to be aware of?
One I want to touch on is deferment, because clients often think that once we basically push the income to the bucket company, we're done. The tax is paid at 25 or 30, which is instead of paying 47, the highest tax rate, we save our tax. But it's a time bomb. It means that eventually all that profit distributed to the bucket company could become what we call retained profit in the company, even though the tax is paid by the company at 25-30% tax rate. Eventually has to come out when the company get wind up or get liquidated, and we call that a tax time bomb. We've got a tax top up, and that needs to be contemplated. There's ways, a strategy to solve that, to fix it with time and with planning, but it's something that a lot of clients forget, and they think, oh, I thought you told me I can save tax by having a bucket company, and that become eventually a tax consideration issue down the track. Yeah.
Absolutely.
The bucket company is Diff 7A. When you have money going into the bucket company, you then loan money out. There's a tax law that prevent you from basically taking the cash and not having to pay additional tax on the cash that the company loan you. So therefore, you're going to have to factor it in. Otherwise, you end up having more tax detriment than it's the benefit of the bucket company, which was initially intended to be used.
Absolutely. And so that's where you may have taken money out of the bucket company and bought a personal use asset, whether it was to do a renovation on your house or a boat or a holiday or something like that. You end up taking that money out, and if it's not returned, you're paying high interest. I think it's high eights, maybe it'll be 9 next year.
It's 9 at the moment.
It's 9 at the moment. So you have to pay 9% per annum principal and interest back to your own entity as a result of taking that money out for personal use or for non-documented uses. And I agree with you, Quang. That's something that we often see of clients found themselves in situations with these Division 7A loans, which I've always said it's meant that you spent money personally that was never your money to spend, because it was the corporate beneficiary's money at that point in time. But definitely the language around tax deferral as opposed to tax reduction is, I think, a good one for us there, Quang. So moving to our clients that are business owners, owning a business has been proven to be a great way of building wealth up over time for lots of our clients. What's the 2 business structures that you're commonly talking to clients about, and how do you help them through this decision at the moment?
Yeah, so we got a very comprehensive checklist in terms of structuring for business setup, in terms of structuring advice. And usually with business, the client, they want to make sure they build the business up to be worth a lot of money and they can exit, and how they can control that process along the way and control the business interests. So when that comes up, we usually have the conversation, okay, we should consider using a company. The company allowed you to own shares, and you can control the share and slowly down dilute or pass those share down as you choose, as you exit or cashed out. And with the company, we also add in a layer called trust, because you're the trust owning the shares in that trading company. What happened is down the track where you made a lot of money on selling the shares, you got a lot of flexibility. We talked all about earlier using a trust to distribute profit and distribute incomes and capital profit out from the trust at a flexible level, which means that it's pretty much the most common strategy structure. I often work with client having a trading company shareholder at a family trust. They get control, they get flexibility, and they can get to minimize the tax along the way as well. And also dividend. Let's run a scenario. If you got a company that's owned by one individual, it's solely owned by one individual. If that company is worth $8 million one day and it paid dividend, everything is stuck in that one individual. And when that individual sells that company shares, that individual is also paying tax on the highest tax rate. There's no ability to income split to minimize the tax on the distribution along the way, where if you have a trust in place, it actually gives you that flexibility and that option.
Yeah, absolutely. And this is sometimes people set up companies quickly. They don't think about the end in mind in terms of this. And it's very difficult to, as we were saying earlier, with property, same with shares, it's very difficult to fix these mistakes a few years after you've started your business because those shares already have value, Con.
Absolutely. There's a way to fix it, but it means harder. You always, my advice is always set it up in upfront correctly. But that means there's a bit more time involved, a bit more cost upfront, but that will set you right. I had a client in a scenario where they had a business successfully run for a company and it was all owned by one individual. And when that transaction went through, it was sold for $50 million, and the cost of that tax structure was quite costly. Had it been structured correctly from day one, would have been quite manageable and the tax would be much more advantageous and cheaper.
Yep, absolutely. Good lesson. So the next question about the structures, just once again in this start with the end in mind, is that they're at a high level, Kwong, there's some concessions for small business owners to sell their business, either when they're young or as they're approaching retirement. What's some of the key kind of considerations that you go through to talk to clients about that?
Yeah, so normally what I do is you look at there's a rule called small concession rule. So when an individual have run a business and successfully run the business and made a lot of money or grow the value of the business, when they sell it, they can access a small concession. And if they meet all the hurdles, condition, the rules can be complicated from a tax perspective, but if you're able to access and get the right advice from your accountant, the taxes get very small and you're actually able to pretty much top up your super, minimize your tax, and able to walk away with a comfortable amount of proceeds which you can use for retirement or to set yourself up for another business or do something else with it.
Yep,
Yeah, it's called small concession.
Small business capital gains tax concessions.
Yep.
And that's the message around that for our clients that are business owners or going into business, is that once again, we've got to set ourselves up correctly at the start, Kwong, for that potential future sale, although it might be 15 or 30 years into the future, still start with the end in mind.
Correct.
Next theme of what we want to talk about in terms of this asset ownership concept, Kwong, is really about the control, the protection, and also bring in a little bit of an estate planning considerations, notwithstanding you're not an estate planning lawyer, but you've obviously sit as part of the trio that help manage a estate perspective. Let's start with control first and foremost, and let's think about that when everything's going, but also then when things start to go wrong, either between business partners or potentially spouses. What are the control mechanisms that people should be thinking about?
Obviously, it depends on the different taxpayer and the different ownership of the assets and whatnot. So in terms of control, if I was looking at individual level, you'd be looking at the title, the ownership. There's different tenant, common, joint tenant, things like that. Also the will, because that's how you control those assets through that process. With trust structures, you'll be looking at the trust deed, you're looking at who the controller of the trust and how things are being distributed, and who the corporate trustees are and who has the power to resign or sack or appoint new trustee. So all those are very important in terms of trust. And in terms of the company, you need to look at shareholder agreements. You need to understand who's have the majority voting power, who has veto votes, and who has the right to control that company in terms of sharing or decision making as well. So those are the stuff that you normally look at when it comes to control for any particular structure of business or
Understood. And as you said, most of those control elements can be customized for that particular family or situation, whether that's in a trust deed with some specific rules or within a shareholders agreement with some specific rules. Both of those documents are not like common law documents that you know what will happen based on common law. You actually have to firstly be an insider to get access to that information, but then reading the shareholders agreement will give you an indication of what would happen. What would happen if we don't have a shareholders agreement, Kwong?
Then it's obviously up to the individual shareholders to obviously make assessments and then to go through the voting process. And if there's a disagreement, then you're going to go to tribunal and then you're going to go to legal. So it's like the shareholder agreement is like your rule book. If you don't have a rule book, then it's going to be up for grab and there's a different decision to be made. And if there's quarrel or disagreement, that's where it doesn't help. And you end up spending more time fighting over what's right, what's wrong, or no, we should have done this way. So it helps to have a rule book for your company if you're having a shareholder agreement.
Yep, Absolutely. And when we spoke earlier about asset protection, but in terms of the family law side of asset protection, in terms of I've set up a discretionary trust and therefore I'm now unfortunately separating from my wife, for example, what's the implications with our family trust and things like that?
Yeah. So we obviously started with saying structure and asset protection, and usually we said trust is a great asset protection vehicle. But one thing trusts don't handle cope well in a family court, it does not work. So the family court has the power to look beyond the family trust structure, and it can decide what assets belong to whoever, depends on what contribution each person put to that family or relationship. I would say one thing is important with trust is to have a look at loans and look at the notion of strategy called gifting. Because if you're trying to look at providing a better asset protection strategy with trust, you can look at those loans, gifting rules, and so forth. That will help you solve their family court. Effective means that if you've done it properly and set up properly and have a good gifting strategy or process in place, put in place, then you could eventually get solve that trust asset or keep that asset away from the family court. That's only one way to get around it. But in a general sense, most trusts the court will look over it and the family court will make decision and control it. You can't rule from your trust and protect it
No,
outside.
understood. And that's the point when we think about asset protection, it's against the creditors that might come through the concept of bankruptcy. It's keeping it simple, not necessarily the division of family assets with the family court. So it's good to highlight that concept as well. And so the on death, Kwong, what happens to the family trust, the company, the trading company, things like that?
Yeah, so I'm glad you raised that because it's interesting. A lot of clients have this perception that when they set up a trust, they own the trust asset, the individual, and the individual go and talk to the lawyer, and then they would then try to will the trust asset in their will. It does
Mm,
not work. As you mentioned earlier, a trust is a separate legal entity. Therefore, the assets then belong to that trust. So when it comes to your death, it is best to plan ahead and going, okay, what asset I can will, what asset I can't will. If I have
mm,
assets in the trust should, how do I put the right documentation so that the right trustee has been appointed when I'm not around? How my role, my power in the trust can be passed on to the people I want, my successors, my executor to manage those, because you can't just put this property is in the trust, it belongs to me, I want you to will it. It does not work that way, legally
mm.
impossible, and they need to plan ahead with that. So usually my summary to that question would be if you have personal assets, you then basically you can put that through your will. If you've got shares, you can certainly put that through your will, and that's easy enough to run it for your will. You've got trust asset, work with your lawyer to basically put controls in place to pass the controlling of a trust to someone else you trust and prepare to give power to.
Mm.
And with super fund, often we think super fund asset belong to us. You can will that, but it's not easy. Often there's ways where it bypass the will because it be considered can be a residual asset of your will or can just completely bypass your will. So you have to have a look at that separately as well.
Yeah, absolutely. And the final one of even more complexity with business owners is that if you have a share and a business and you pass away, there's the concept of a will, somewhat of a will for the business. I suppose we would call it a buy-sell agreement, Kwong, that transacts and sells the equity maybe to the other business owners. If I don't have that in place, what happens?
Then again, you go back to obviously your shareholder agreement, see what it says in there. Yeah. And obviously, if there's none, then obviously then it's up to the party, the shareholders to sit down at a table and negotiate how they want to sell their interests and assets, basically. Obviously, the best thing is to have the buy-sell agreement, and obviously you got insurance in place for that as well. That'd be perfect, right? You know what I mean? But if it doesn't happen, then you're going to have to look at what the call it the executor or the deceased, the spouse of the deceased want to do with the asset because not everyone, the spouse who receive that share of the trading company often don't want to continue running that business, doesn't continue to maintain a share in that company.
Mm.
Therefore, it has to be a way to exit. And unless you have those two things you talk about, a proper exit agreement and a buy-sell agreement and proper shareholder agreement, spelling that out, you're going to have to sit down around table and negotiate in good faith.
Absolutely. And that's the common example that we speak about in terms of saying, do you want to be as business partners, do you want to be in partnership with your spouse's business, the spouse of your business partner? Because if you don't put these documents in place, essentially you could end up finding yourself in that situation, which is an unintended consequence. So we definitely need to have the concept that we've got a will, as you say, Quang, to deal with your personal assets, a document to deal with your trust assets, and a document to deal with your business assets if they're relevant as well through that process. So that's really good. What's some of the things that maybe we haven't spoken about today that you would think is important for your clients to hear?
Look, I think the main thing really is for them to understand what they want, because often I sit down with a client, I say to them, what is the goal? What are you trying to achieve? Are you looking to have something for short term or long term, or are you trying to set this past asset to someone for next generation to come? And once you're clear on those, then we can then go around, help to put the right structure, put the right entities, and then give you the right advice so that we can manage it. I would say there's no such thing as one size fit all structure. There's no such thing as set and forget structure. You always have to revisit it. You always have to review it every year. And if it doesn't work, then you have to revise it and change it to ensure that it matches your purpose, because people's goal and plan change. You have different partners in life, you have different goals in life, and you go through a different journey in life. So therefore, you have to sit down and reassess those on a regular basis, and which is what we do with our clients.
Yep. Very well said. And the other thing we didn't mention there is that not only does your situation keep changing, the rules around us keep changing a little bit too, Quang, and that does mean that we have to review our former asset structure to make sure it's fit for purpose on an ongoing basis. So really appreciate your time, Quang, today, sharing some of those insights. I do want to highlight that we do have an ongoing event. So Stella, who's a financial advisor at Absolute Wealth Advisors, is coming on board to talk to us about Centrelink next month on the 3rd of June. So for those clients, we'll send out a reminder and link to register for that as well. The highlight there is that the assets that you can hold personally and still qualify for Centrelink or aged care cards and things like that is actually increasing. So it is something to take into consideration and speak to your advisor with as well. So Quang, I don't think I've got any questions that have come through today. Thank you very much for your time, and we'll see you next time.
Thanks, Steve. Pleasure.
Thanks, Quang. Bye-bye.